Okay, let's take the conversation now to Venugopal Manghat, Chief Investment Officer Equity at HSBC Mutual Fund. He joins in with his thoughts on the markets and the way forward. Thank you very much for joining in. This is Rima here. So let's first start with the, top down. Now, as we enter the second half of the year, what are the big bets that you have at HSBC India? And are you fully invested in equities now?
Good morning, Rima. Thank you for having me on the show. Yes, I think we have always remained almost fully invested. We've never used cash as a strategy. So that's the first point. On a top-down basis, I think the markets are looking, or the economy is looking much better now. The second half of last year, we saw a number of factors turning negative, including the Capex from the government side. I mean, this is the first half of financial year 2025. And then, the liquidity pressures that we saw, the regulatory pressures on for lending, especially to unsecured on the unsecured side, all of that actually resulted in the overall economy slowdown. And from there, we've actually come a long way. I think the Capex numbers are very strong now. Government Capex has picked up very strongly. If you look at the March, April, and May numbers as well, I think it shows a very significant pickup. We have seen a complete change in terms of liquidity from a deficit to a surplus, and more to come with the CRR cut. We saw a 50 basis cut in interest rates as well, which is yet to be fully transmitted into the system. So we think the stage is set for better growth on a top-down basis. We currently are working with the 6.5% GDP growth estimate, which is what the RBI has also projected. But my sense is it could surpass that, given all of these factors. And as we go into the second half, hopefully there will be some clarity on the global side as well.
Right. Venugopal, growth is a function of the Capex. It's a function of consumption. It's a function of what the government spends are, and it's a function of the exports. On all those four fronts, where do your preference lie? Because you did believe that Capex is coming back. Would you play this growth via Capex-related stocks, or do you look at the other functions as well?
So I think the last 2 or 3 years, we've seen Capex and investments leading the markets and being a big driver of growth for the economy as well. We've for some time believed that consumer discretionary and consumption will pick up. We've not seen numbers yet or data yet to show that or reflecting that. But our sense is that with the tax incentives or the SOPs that have been given in the budget, plus the liquidity, the easing of regulatory regulations on lending, and the transmission of lower interest rates over time, all of that will lead to consumer discretionary picking up towards the second half, meaning the last quarter of this calendar year. We should see the data also coming positive. In the shorter term, I think the investment related sectors, the Capex related sectors, will have to take the continue with the run. I think that's the single biggest driver at this point in time, given that consumption will take slightly more time to really pick up from the bottom that has been made. We strongly believe that going into the next financial year, consumption will be a key driver of growth, which is the non-staples part, which is the discretionary consumption piece, whether it is retail, whether it is automobiles, whether it is multiple other sectors, including QSR, etc. It could start with the low-ticket consumption items first, and then over time move into the bigger ticket, automobiles and housing, etc. So that's the way we see the progression in terms of sectors and growth in the economy.
All right. Hi, Mr. Manghat. Good morning and good to see you in. Good to hear your thoughts as well. Everyone's talking about better macro setup. However, the credit growth has been a little bit worrying, right? I mean, you would want better credit growth. Are you worried, or do you believe the triggers are in place and credit growth will recover to say 12-13% by the time we wind up this year? Your take?
Yeah, we were worried earlier. A couple of months ago, we were really worried that, credit growth is weakening. And I think I spoke last time we met, or I was on the channel, I spoke about that. It was quite sluggish at that point in time. But now, with the liquidity enhancing measures from the central bank, the surplus liquidity at the moment, the CRR cut announcement, all of this should lead to an easing of pressure on the banking system. Deposit growth has now surpassed credit growth for the first time in multiple months, and in May now. With the CRR cut of 100 basis points, eventually over the next 12 months or more, you could see a significant, injection of money into the system, about 2,30,000 or 2,50,000 crores. And that, with a multiplier, should impact or help the credit growth to pick up. So we believe, by the end of the year, we should clock again a 12 to 13% credit growth in the system.
What about IT? Now, IT is still trailing. It's still about 15% away from its highs, while the Nifty is almost there, just a couple of 100 points, couple of 100 points here and there. Now, IT stocks are entering a seasonally strong period. Q1 and Q2 is typically the quarter when growth rates pick up. And incrementally, we haven't seen, too much by way of bad news. In fact, CLSA is saying that Infosys is likely to upgrade its guidance. So from 0 to 3%, they could increase it, to 1 to 3% or 1 to 4%. Do you think there could be positive triggers for the Indian technology space in Q1? And tactically, there is any opportunity?
So I think the IT sector was impacted, with all the uncertainty, in the global environment, the expectations of U.S. Growth slowing down, U.S. economy growth slowing down, and the tariffs, etc. So that the whole environment turned negative. And even though I think the first quarter is seasonally a good quarter, like you mentioned. The expectation was this year, given this uncertain environment, it would be quite weak. I think the consensus numbers and most analyst expectations are either flat or negative growth on revenue front. But the positive news, I think, is coming from the view is coming from the fact that so far we've not seen demand really fall off the cliff. I think BFSI is still holding up. The more impacted sectors are manufacturing and retail, which probably is slow in terms of decision making and on discretionary spends. But overall, I think the demand has held up till now. So in that sense, we might see some better than expected results, given that the expectations have been quite subdued. Having said that, I think the commentary again will have to be, we'll have to wait and watch and hear the commentary, because going forward with a lag, some of these could really impact growth in the US, and we'll have to take stock, when companies announce results and what their commentary is.
All right, Venugopal, thank you so much for joining in and giving us your view on the markets. In the very near term, you believe that Capex will lead the market, and thereafter you see consumer discretionary picking up as well. Still not pretty sanguine on the IT space yet, but you are picking some in the financial. With that, we'll take your leave and wish you a good day.